Our topic for today is taxation in the Philippines. But before that, let me introduce myself first, your presenter for today. I am Jason Valerio, a first year college student from Pangasinan State University or the Neta City campus, who is currently taking up Bachelor of Secondary Education major in science. So much so for that, let us first know our learning objectives and expected learning outcomes for this topic. So our first learning objectives is to understand the fundamental concepts of taxation. Second is to analyze the impact of taxation on the economy and society. The last one is to explore the intricacies of tax laws and regulations in the Philippines. And for our expected learning outcomes, at the end of this presentation, you are expected to have the ability to comprehend the complexities of Philippine tax system, and you will have enhanced knowledge of taxation principles and their applications, and you will have improved awareness of the role of taxation in the socio-economic development of the Philippines. But before we fully start the presentation, let's have first a pre-test assessment, and you will be given at least 2 minutes to answer these 5 questions, and just answer what you know. So for the introduction part, let us define first what is taxation. So taxation refers to the practice of a government collecting money from its citizens to pay for public services. Simply, without taxation, there would be no public parks or libraries. And for the other translation, the process by which the government of a country obtains money from its people in order to pay for its expenses. So, the government or a taxing authority obtains the right amount of money from its citizens based on their earnings and properties as a payment for public services. Let's now move on to the Bureau of Internal Revenue. The Bureau of Internal Revenue, or Kawanihan ng Rentas Internas, or simply BIR, is a revenue service for the Philippine government, which is responsible for collecting more than half of the total revenue of the government. It is an agency of the Department of Finance, and it is led by a commissioner. The Bureau of Internal Revenue is mandated by law to assess and collect all national internal revenue, taxes, fees, and charges, and to enforce all forfeitures, penalties, and fines connected therewith, including the execution of judgments in all cases decided in its favor by the Court of Tax Appeals and the ordinary courts. Let us now recognize the importance of taxation in the Philippines. So, according to Senate Bill number 121, the primary purpose of taxation is to generate funds for the country to finance the needs of the citizenry and to advance the commonwealth. The Philippine government relies on tax revenue to fund its operation and finance its development projects. Being the lifeblood of the government, tax revenue is a critical part of the country's economic and fiscal policy. And taxation in the Philippines plays a crucial role in funding public services, infrastructure, and social programs. It is a primary source of government revenue, enabling the country to finance essential services such as education, healthcare, and public safety. Additionally, taxes contribute to economic stability by helping manage inflation and promoting equitable distribution of wealth. They also support the government's ability to address socio-economic challenges and stimulate economic development. Let's move on to historical background of taxation in the Philippines. The evolution of tax system in the Philippines has undergone significant changes over the years. Let me give you the brief overview. From 1521 to 1898, during the Spanish colonial period, tribute or tributo and cedula taxes were imposed on indigenous Filipinos. These were regressive taxes, placing a heavier burden on the lower income population. This one is from 1898 to 1946, during American period. The United States introduced a more structured tax system. The Revenue Act of 1904 laid the foundation for income taxation, and over the years, various tax laws were enacted to adapt to economic developments and the changing needs of the government. And the third one is from 1942 to 1945 during the Japanese occupation here in the Philippines. The Japanese implemented their tax system during the occupation, imposing heavy taxes on the Filipinos to fund their war efforts. And for the fourth one is during the post-World War II era. After the war, the Philippine tax system was reconstructed or restructured. The Republic Act number 39 of 1946 reintroduced progressive income taxation and subsequent laws further refined the tax system. And from 1970s to 1980s, martial law under former President and dictator Ferdinand Marcos led to the introduction of Presidential Decree number 1158, known as the Internal Revenue Code of 1977. This consolidated and updated tax laws, emphasizing a more comprehensive and integrated tax system. And for the last one, from 1990s up to present, the Comprehensive Tax Reform Program, or CTRP, was initiated in the 1990s, aiming to simplify the tax system, promote efficiency, and enhance revenue collection. Various tax reforms such as value-added tax system were introduced. In recent years, the tax reform for acceleration in inclusion or TRAIN law aimed to adjust income tax rates and update other tax provisions. So, throughout these periods, the Philippine government has continually adjusted its tax policies to meet economic challenges, stimulate growth, and address social needs. The evolution reflects a constant effort to strike a balance between generating revenue for public services and fostering economic development. Let us now know the types of taxes in the Philippines. So, tax law in the Philippines covers national and local taxes. National taxes refer to the national internal revenue taxes imposed and collected by the national government through the Bureau of Internal Revenue. And local taxes refer to those imposed and collected by the local government. So, first is income tax. An income tax is imposed on individual or entities or taxpayers in respect of the income or profits earned by them. It is commonly called taxable income. So, income tax is a tax on a person's income, emoluments, profits arising from property, practice of profession, conduct of trade or business, or on the pertinent items of gross income specified in the Tax Code of 1997, as amended, less the deductions, if any, authorized for such types of income by the Tax Code, as amended, or other special laws. So note that the deadline is on or before the 15th day of April of each year, covering taxable income for calendar year 2018 and thereafter. So you can see here the income tax rate. So if your annual income is from 250,000 and below, your income tax rate would be 0%. And if your annual income is ranging from 250,000 to 400,000 pesos, 20% of the excess over 250,000. And if you are if your annual income is from 400,000 to up to 800,000, your income tax rate will be 30,000 plus 25% of the excess over 400,000. And if your annual income is ranging from 800,000 up to 2 million, your income tax rate would be at 130,000 plus 30% of the excess over 800,000. And and if your annual income is around 200,000 2 million up to 8 million, your income tax rate would be 490,000 plus 32% of the excess over 2 million. And if your annual income would be if your annual income is ranging from 8 million above, your income tax rate is around 2,410,000 plus 35% of the excess over 8 million. The next one is the value added tax. Value added tax is a business tax imposed and collected from the seller in the course of trade or business on every sale of properties. It's either real or personal, lease of goods or properties, or vendors of services. It is an indirect tax, thus, it can be passed on to the buyer. In the Philippines, the VAT rate is set at 12% and it is applied to the taxable gross selling price of properties and goods along with the gross value of service receipts and property leases. We have excise tax. Excise tax is a tax on the production, sale, or consumption of a commodity in a country. It applies to goods manufactured or produced here in the Philippines for domestic sale or consumption, or for any other disposition, and to imported goods. There are two types of excise tax: specific and ad valorem. Specific tax refers to the excise tax imposed which is based on weight or volume capacity, or any other physical unit of measurement, while ad valorem tax refers to the excise tax which is based on selling price or other specified value of the goods or articles. Moving on, we have the property tax. Property tax is an annual tax on real property. It is usually but not always a local tax. It is most commonly founded on the concept of market value. The tax base may be on the land only, the land and buildings, or various permutations of these factors. And real property tax rates is at 1% to 2% of assessed value. Under Section 233 of Local Government Code of 1991, the following rates of property basic real property tax are prescribed based on assessed value of real properties in the Philippines, which is 1% for province and 2% for city or municipality within Metro Manila area. The last one, we have estate tax. Estate tax is a tax on the right of a deceased person to transmit his or her estate to his or her lawful heirs and beneficiaries at the time of death and on certain transfers which are made by law as equivalent to testamentary disposition. There shall be an imposed rate of 6% based on the value of such net estate determined as the time of death of decedent, composed of all properties, real or personal, tangible or intangible, less allowable deductions. And now let's have contextual analysis of taxation issues in the Philippines. So, the taxation landscape in the Philippines is shaped by various economic, social, and political factors. So, let's have a contextual analysis. First is economic landscape. So, from economic growth, the Philippines has experienced consistent economic growth, influencing tax revenue. However, challenges like the informal economy impact revenue collection. So, global integration. As a participant in the global economy, the Philippines is influenced by international economic trends affecting trade and tax policies. So, the second one is social dynamics. Um, Income inequality. Addressing income inequality is a social challenge, and the tax system plays a role balancing the tax burden is crucial to ensure equitable contribution. And for demographic trends, population dynamics influence tax policies, especially in areas like social services and healthcare. Next one is political environment. So, for policy reforms, the government stands on tax policy reforms and its commitments to addressing challenges impact the trajectory of taxation. And for political stability, it contributes to effective policy implementation and reinforcement. And legal and regulatory framework. For tax legislation, the National Internal Revenue Code forms the backbone of tax laws, but amendments and updates are necessary to address evolving economic conditions. And for enforcement mechanisms, the effectiveness of tax enforcement administered by the Bureau of Internal Revenue plays a crucial role in revenue collection. Um, Next is global influence. International agreements. The Philippines' participation in the international agreements and organization can influence tax policies, especially in the context of global tax standards. And for technological advances, we have digital economy. The rise of the digital economy poses challenges in taxing online transactions, requiring adaptations in tax policies to capture revenue for these activities. And we have environmental considerations. Um, Green taxation. Environmental concerns may lead to exploration of green taxation policies to promote sustainable practices. And for the last one, we have the crisis response. So, as we all know, pandemic impact. The COVID-19 pandemic has strained fiscal resources, leading to adjustments in tax policies to address economic challenges. Now, let's examine the tax evasion and avoidance issues. So, we will know its definition, methods, consequences, prevention, and detection. So, tax evasion involves illegal activities to reduce tax liability, such as underreporting income, inflating deductions, or hiding money in offshore accounts. Um, in its methods, um, when you are underreporting income, individuals or businesses may intentionally report lower income than earned to pay less tax. And manipulating the deductions, it is when you falsify expenses or deductions to reduce taxable income, and it is a common evasion tactic. And hidden assets, it is when you conceal assets or funds in undisclosed accounts to evade detection. So, of course, it will have consequence. The first one is legal penalties. Tax evasion is a criminal offense, leading to fines, imprisonment, or both. And the next one is loss of public trust. Individuals or business caught evading taxes face reputational damage and loss of trust. So, how can we prevent and detect? We must have a strong enforcement. Uh, Robust tax enforcement and investigative measures are crucial for detecting and deterring evasion. We can also use the technology by implementing advanced data analytics and technology to identify discrepancies and patterns. And the next one is tax avoidance. Tax avoidance involves exploiting legal loopholes or using strategic plan to minimize tax liability without violating laws. So your methods will be transfer pricing and tax haven and the use of tax credits and incentives. So for transfer pricing, shifting profits between subsidiaries in different tax jurisdictions to benefit from lower tax rates. And for tax havens, it is when you establish entities in low tax or no tax jurisdictions to reduce overall tax liability. And the last one, it is when you legally taking advantage of available tax credits and incentives. And it's also have a consequence. First one is public scrutiny. Uh, Aggressive tax avoidance can attract public criticism, affecting the reputation of businesses. And next one is changes in legislations. So, government may respond to aggressive avoidance by closing legal loopholes or amending tax laws. Now, how can we prevent and mitigate tax avoidance? So first is international cooperation. Collaborative efforts between countries to address cross-border tax avoidance and transparent reporting is when you advocate for greater transparency in financial reporting to reduce opportunities for avoidance. Addressing these issues requires a multifaceted approach, including legal reforms, international cooperation, and the use of technology to enhance detection capabilities. Regular updates to tax laws and collaboration between governments and businesses are essential in mitigating both evasion and avoidance. And that ends our discussion. We will now have a post-test assessment regarding taxation in the Philippines. I'll be giving you 30 seconds for each questions, which is 10 items, and you can send your answers to me via DM. And that concludes our presentation. Thank you for watching.